Stress testing is like running your portfolio through a financial hurricane simulator. It shows you how your investments would perform during extreme market conditions, helping you identify vulnerabilities before they become real losses. Portfolio stress testing applies severe market shock scenarios to your investments to see how they would hold up during crisis conditions. Think of it as a worst-case scenario planner that goes beyond normal market volatility. Regular risk analysis looks at typical market movements, the day-to-day ups and downs. But stress testing examines what happens when everything goes wrong at once: market crashes, interest rate shocks, currency crises, and liquidity freezes. These are the events that can devastate unprepared portfolios. The system applies 7 major stress scenarios simultaneously. The underlying model for stress testing is always geometric Brownian motion, as it is a very popular modular that explicitly assumes volatility parameters. These, with the addition of increased correlation coefficients, are the ones that will be stressed during this analysis. Market crash scenarios test severe equity declines of 30 to 50%. Interest rate shocks apply sudden 200 to 300 basis point rate movements in both directions. Credit spread widening simulates corporate bond stress when investors flee to safety. Currency crisis scenarios test major devaluations and foreign exchange volatility spikes. Liquidity crisis testing shows what happens when asset markets dry up and you're forced to sell at steep discounts. Volatility spike scenarios examine extreme market uncertainty periods. Finally, correlation breakdown testing reveals what happens when diversification fails and all your investments move in the same direction. Each scenario is based on historical crisis events, so you're testing against real market conditions that have actually occurred, not just theoretical possibilities. Running a stress test requires minimal setup but yields maximum insight. Start by ensuring your selected financial model is appropriate for stress testing. You'll find the setting in cell B18 of your parameter sheet. Next, enable stress test comparisons in cell B54. This allows the system to generate comparison charts and detailed result analysis across different scenarios. Without this enabled, you'll get basic results but miss the powerful comparative insights. Verify that your portfolio data is current and complete. Stress testing reveals vulnerabilities, but only if it's working with accurate position information. Outdated data can give you false confidence or unnecessary panic. Of course, you can modify these coefficients and create your own stress test scenarios. Once everything is configured, simply click the Run Portfolio Stress Test Analysis button. The system automatically applies all 7 stress scenarios to your portfolio, calculates losses under each condition, and generates comprehensive results.
Your stress test results appear in the Stress Results worksheet with several key outputs that guide your risk management decisions. The most critical information is the stress loss estimates by scenario, showing exactly how much your portfolio could lose under each crisis condition. Pay closest attention to the worst-case portfolio decline projections. These numbers represent your maximum potential losses if these scenarios occur. If the largest loss exceeds your risk tolerance or available capital, you need to adjust your portfolio immediately. Asset-level stress contributions reveal which specific investments are creating the most vulnerability. If 1 or 2 assets account for most of your stress losses, you have dangerous concentration risk that needs addressing. Recovery time estimates show how long it might take your portfolio to return to current levels after each stress event. Long recovery times indicate illiquid positions or structural portfolio problems that compound losses. Look for patterns in your results. If multiple scenarios produce similar large losses, that suggests your portfolio lacks effective diversification. If one scenario produces dramatically worse results than others, that reveals a specific vulnerability you can address through targeted hedging or position adjustments. The Stress Test Summary Dashboard provides an at-a-glance view of your portfolio's resilience across all scenarios. Use this for quick assessments and regular monitoring of stress exposure changes over time. Stress testing serves multiple practical purposes beyond just knowing your worst-case losses. Use the results for immediate risk management by identifying and reducing dangerous position concentrations. Set position limits based on stress contributions to prevent any single investment from dominating your risk profile. The results support regulatory compliance requirements for many institutional investors. Document your stress testing process and results to demonstrate prudent risk management to regulators and boards. Most importantly, use stress testing for strategic portfolio improvements. If your stress losses are unacceptably high, consider reducing overall risk levels, improving diversification, or adding hedging strategies that perform well during crisis periods. Run stress tests regularly, especially after significant portfolio changes or when market conditions shift. What looks like a well-diversified portfolio during calm markets might reveal dangerous vulnerabilities under stress testing analysis. Remember that stress testing shows potential outcomes, not certain futures. Use the results to prepare for adverse scenarios while maintaining appropriate investment returns during normal market conditions. Stress testing reveals portfolio vulnerabilities that normal risk analysis misses. Regular stress testing helps you sleep better knowing your portfolio can survive financial storms.